I'm taking a look at the 10-year interest rates to formulate my plan for how I want to approach any kind of trading. This will help give expectations so that if anything happens outside of my expectations, I'll know that I've got to adjust my plan. You can see the interest rates kind of are riding in this general growth trend upward towards 3%, and they get rejected here. And so, you'd expect some kind of pullback to the lower bound, where it came in here, and then hopefully you get, I mean, hopefully, well, really what I'd expect rather than hope for is that you'd get something like this, a pullback into here, closer towards, 2%ish, 1.9 to 2.1% on the 10-year. And what that would do is I'll look at even this here is going kind of, look, you got 1.75 on the 10-year. So yeah, maybe even like down to here if things get crazy. So if that comes down, I'd expect the consumer staples stocks, the General Mills, Kellogg's, Smuckers, even Walmart, Procter Gamble, Kimberly-Clark, Colgate-Palmolive to kind of get a bid and get stronger. And for the cyclicals like ExxonMobil, the other energy names to get weaker. So the main idea is that this 2.75 on the 10-year is, I'd expect, the top for some time until we get to maybe, it doesn't come all the way down. Maybe it comes kind of to 2.5 before it comes back up. That would be something to look out for. But I'm hoping that we do get some kind of a growth scare and we get the 10-year to come all the way back in. This is kind of what I would be operating under, the assumption that it does come all the way back in to this lower bound right in here. All right, and that would scare out a lot of guys. I'd look for some kind of buying in this area here. It's going to scare people and give you a much, much better price to buy any of these materials, energy names, gold, copper names, uranium, fertilizers, nat gas, those types of, and even the cyclicals. Maybe you would wash out the industrials. Maybe you look for a bottom in the transports too. Once we get something in here on the 10-year, because 10-year is the main driver of the stock market right now. Being the higher it goes, the more you can judge that inflation expectations are starting to worry market participants. As a rough gauge for inflation expectations, you can use the 10-year. Too much inflation, not good. Little bit of inflation, pretty good. Deflation will just make stocks go to the moon. So I guess, if we're operating under the normal, QE era still, I guess deflation is always just going to make stocks go crazy on the upside. So that'll be my operating procedure. And if anything happens outside of that, like if you get some kind of just bang and move higher from here, that would be concerning. Through 3%, right? I think this is kind of the ceiling at 3. This right here, it's really kind of a big red line here. Now, if rates go through here in a big way through 3% and maybe come back down and take off again and hold above 3, that's concerning. And then I would be completely at a loss for what's actually happening, and I would not buy anything. But if rates come down from here, and I'd be a buyer down here. So that's my plan. I can't do too much until we get some kind of a lower move in the rates to scare people out, because then they'll think deflation is going on. And I assume rates are on an upward trajectory now for quite some time for the next year, 2, 3, maybe 4, maybe 5 years. Okay, and that's the plan for now.